Does everybody have a report that would like to have a copy? Okay. Okay, so if y'all could turn to page 1, presentation of the valuation results. What's that? It's just the report. Yeah. So we'll put it as I go through the report. We'll put the slides up, but I mean you all have the book, so. Okay, so this valuation is mixed results. There's some measures are good news, some measures are not quite as good news, but overall I think it was not a bad valuation report compared to the prior year. Some things I want to bring to your attention. Remember in January we presented the experience study. So the board adopted all new actuarial assumptions. So this is the first valuation report based on the new actuarial assumptions. And at the time we told you that we expected an aggregate contribution rate decrease of about 0.7%. And we expected the normal cost to decrease by about 4%, 0.4%. I wish it was 4%, 0.4% in aggregate. So those things we saw in this valuation report pretty much as we expected for the change in the assumptions. Now there's other things going on top of that, but we expected the impact from the change in the assumptions. It changed pretty much as we expected. So let's go to page 1, the summary of results. You'll notice first for retirees and active members there was a slight increase in both numbers. Both increased by about 0.5%. The drop membership continues to decrease. We've been seeing this for the last 10 years, and I think that that's because members are only earning the returns on the self-directed accounts that are going into drop now, as opposed to the older members who received the actuarial rate of return less than 0.5%. And the number of terminated vesteds, there was just a small increase there. It remains fairly flat. Annual benefits, there was an increase from $1,275 million to about $1.3 billion. That's actually a relatively small increase, and it's in part due to the increase in the number of retirees, but also as the older retirees come off the plan due to attrition and are replaced by newer retirees with higher benefits, that contributes to the higher benefit payment numbers. The total payroll, here we saw a significant increase. That's an aggregate increase of 4.7%, almost 5%, from $1,864 million to $1,952 million. And the reason for this, I checked with Trey because at first we wanted to make sure we weren't doing something incorrectly where that might have this number increasing more than it should have. And Trey reminded me that this is the first full year of the new compensation structure. So last year we had some of the increase built in, but this is the full fiscal year where the full impact was reflected, and that's why we're seeing this increase here. So I think going forward, at least based on what was explained to me based on the new compensation structure, we should return fairly close to what we had before in terms of annual changes, and maybe slightly lower. And we've taken that into account in the salary assumptions that we just built in. The market value of assets saw almost flat. Last year we were at $12,283 million. Now we're at, basically $12,283 million. So, and that changes with the investment returns on the market value of assets, as well as contributions and expenses. But we did see, we'll get to this in just a second, a positive return on the market value and valuation assets. So the valuation assets, this is the actuarial value of assets less the side funds, which for lasers, the only side fund is the experience account. And there you'll see there was an increase of about $160 million from $12.36 billion to $12.52. I was wondering if I wanted to turn you to another page, but let's not go there yet. So the experience account, you'll see that there's a very small increase there, and that's because of the small positive actuarial return. We basically just credited interest on the account balance. There were no additional investment earnings allocated to this account, so that's why there's such a small increase there. The market value return was 3.76%, and that's on total plan assets reflected in the financial statements. That's going to be off a little bit from what's reported in the investment committee for fiscal year end because they're reporting on investment returns on invested assets, and this is on total assets, so includes the building and any other assets that they're not investing for the trust. So if we have the market value of assets excluding the self-directed accounts where the newer members in DROP direct their own assets and they have a lower return, we pull those out, and that's why we have a slightly higher market value return net of those items, and that's at 3.81%. The actuarial value of assets, which is the smooth return where we gradually recognize the 20% of each year's gains and losses relative to the discount rate, there we see a return of 5.18%. We compare this to the discount rate for the period, which was 7.65%. And so because this is less than the 7.65%, there's an investment experience loss. And as I continue from here, I'll show you how that impacts the other numbers that I'll be presenting. So 0.5% less than that is what will be credited to the DROP accounts for members that were eligible for DROP prior to January 2004, and so that is 4.68%. The total normal cost on a dollar basis remained fairly level. Last year it was $219 million, now it's $220 million, but you'll notice as a percentage of payroll it decreased from 11.74 to 11.29, and this is what we expected. This is a direct result of the new assumptions, and mainly what was driving this for the normal cost was the decrease and the salary increase assumptions. So that has the impact of lowering the cost of the benefits that the members are accruing each year. And so net of what the employees pay, the employer portion of the normal cost rate is decreasing from 3.72% to 3.24%. The UAL, unfortunately, this is one that doesn't feel so good because it happens to cross the threshold of back up to a number we didn't want to see again. From 6.7 billion to now we're just over 7 billion on the UAL. And so let's turn to page 5 and I can walk you through the reasons for that change. Actually page 4, bottom of page 4. So last year, starting with the 6.7 billion, first, the UAL accrues interest because it's a discounted benefit number. And so if you go one year into the future, you're losing that 1 year's worth of discounting. So we have to increase it first by the interest on the UAL, and that was 516 million. But we received in amortization payments almost 650 million, 648.9 million. And so the net difference of those two is a reduction of about 130 million to the UAL because we're now paying principal when we receive those payments. The legislative acts income, this was from the surplus income that was allocated or appropriated to lasers, and it also includes litter fines, a whole $1,135.
That didn't lower the UAL.
Didn't lower the litter either.
I know, somebody needs to be out there following these guys and writing down license plate numbers. And so the difference there, pretty much all of the $9.5 million is from Act 50 of 2019. And we now know that we can expect an even larger, probably about double this amount next year due to the surplus from the last fiscal year, which is good news. The investment experience loss, so where I referred to the actuarial return of 5.18 as compared to the 7.6 7.65 is what we assumed for the prior year. That difference is what makes up the investment experience loss. It's not that there was a loss. We had a positive return, but we had a loss compared to what we assumed we would achieve. And so that is what results in the $286 million increase to the UAL. And so when we take that number and amortize it over 30 years, unfortunately, it takes away some of the reduction in the contribution rate that we were expecting from the experience study, which I'll get to those details in just a minute. We had an other experience loss, and what that is basically all other actuarial assumptions, how the experience played out relative to what we assumed would happen, and that contributed to a loss of $95 million. So let's go to page 5 real quick, where I break down that loss. This is something that we added 2 or 3 years ago to the valuation. In the middle of the next page, we break down what are the reasons for that loss. So you see it totals up to the $95 million. And the reason for it, in active member decrements, that is everything that can happen to an active member differently than what we expect. So whether they choose to retire, go into drop, become disabled, terminate employment, the extent that all of those differ from what we assumed, that was the majority of the loss, $64 million, which when you look at the total liability for lasers, this is a very, very small number, and it actually shows that our assumptions are appropriate.
Does that happen every year?
Yes, every single year. And usually, every single year there is a gain or loss. I don't have the prior year numbers with me. I think that number's pretty consistent with what we usually see, though. So what will be interesting to see what happens next year when we have the new assumptions in place, and then hopefully we'll have a closer number to zero there, whether gain or loss, hopefully closer to zero. Active member salaries, we had a loss here, and that's because salaries increased more than expected. We almost always have a gain here because in almost every year since I've been doing this, the salaries have increased less than we expected, which means liability increases less than we expected, and so we've had a gain. This is the first year that we have had a loss, and that's because of the new salary structure, and salaries increased more than we expected. But actually, so we have to take this amount and amortize it over 30 years, but then we're also amortizing the current UAL payment over this higher salary amount, and that resulted in a pretty big reduction to the contribution rate, and I'll show you that number in just a second. So this is not all bad news. With salary, there's always, whichever way it goes, it brings good news and bad news. It's just what's the net impact. Inactive mortality at 26, it's a 26 million gain. That number, for the total inactive liability to have a 26 million gain, that's saying that our mortality assumptions are pretty much right on. And this is the mortality assumptions before the experience study, but we didn't make that great of a change to our current assumptions. So I think what we have in place now with the new assumptions is going to give us pretty good results. Administrative expenses, in the past, we would have had a loss here. Prior to last year, well, even last year, we had a loss here, and that's because this past fiscal year is the first year that we've pre-funded the administrative expenses through direct funding through the employer contribution rate. So in the past, we would have always had a loss that we anticipated, and we had it built into our assumptions, but we'll no longer have that loss, and we no longer have to build it into our assumptions. And what I mean by that is, remember with the discount rate, we used to have to build in an extra margin, one for gain sharing and one for administrative expenses. We no longer have that 0.15% margin for administrative expenses. So with the direct funding, those two things happen. We no longer have to fund for it, and then we no longer have gains and losses because it's paid directly. The only gain or loss is just how were the expenses different than what we assumed. And Artie does a good job of giving us a sense of what they're going to be the next year, so this number should always be pretty close to zero.
What's close to zero, Artie?
This is pretty darn close to zero. I got to take up for him there. Okay, and then the other is just, you know, we can't, this would be a 3-page document if we were to not have an other category. So we basically just throw everything that's not already accounted for here into the other category. And you see that that's 7.3 million, which is basically zero in my mind. So now let's go back to page 4. The employer contribution surplus. This is a surplus because, why would that be? Because salaries were higher than we expected. And so even though we expected on a percentage basis a deficit, we had a surplus because of the rate that was paid in. It was paid on a higher salary base than we expected. So we ended up with a $44 million reduction to the UAL because of that. The other assumption change, this is all of the other assumptions other than the discount rate. The changes in the assumptions from the experience study resulted in a decrease to the UAL of 17 million. The discount rate changed from 7.65 to 7.6%. Increased the UAL by about 86 million, which this is around what we've seen every time we've done a 0.05% step down in the discount rate. So it's pretty consistent there. And then the legislative change, this is a really small increase, and that's due to the, I forget the term. Let's go to page, I have it all described here on page 3. Act 595. Last year we included some increase in the UAL for this. This is the intentional act, the disability for intentional acts of violence. We had 3 or 4 members that had been approved by the board by the time we did last year's evaluation, and then through the fiscal year, through fiscal year ending 2019, I think there were another 3 or 4 members that were approved. And I think that should be everyone now, so there will no longer be another increase in liability. That's now been fully accounted for. So that explains the increase in the UAL. So let's go back to page 1. So because the accrued liability increased more than the assets, we have a small reduction in the funded percentage. So you'll notice a little more than halfway down, the funded percentage decreased from 64.7% to now 64.1%. So this very next line is something that I added at Daryl Prepara's request in PERSAC last year. It continues to bother him that we have a discount rate that differs from the expected rate of return. And we had added the discount rate to this page last year or the year before because we felt like it was confusing that we're basically accounting for 3 different discount rates. We're looking at what did we assume last year, because that's how we determine our investment gain. What are we assuming for the immediately coming up year for our restated contribution rate, and then what's our discount rate for the following year. And so I thought that got really hard to keep track of what discount applies where. So we added the discount rate to this page. And then Daryl felt like that was misleading because the discount rate is not the same as the assumed rate of return, so he asked that we add that. So that's what I've done here, and I've gone back and included the prior 2 years, and I'm showing both of these numbers for the current year and also for the next fiscal year to show what's the basis for the employer contribution rate that we're recommending for fiscal year ending 2021. The next line, employee contribution, we're expecting the employees to contribute a slight increase from 150 million to 157 million, and that represents about 8.05% of pay. And the reason why that's not 8% is because it's an aggregate number for all plans. So the rank and file, we still have some at 7.5%. By far the majority are now at 8%. And then all of the hazardous duty plans, the new one and all of the closed plans, employees contribute more, and so the aggregate comes out to slightly above 8%. And the reason why that's increasing every year is because we have more people still coming on to the 8% from the 7.5%. Employer contribution. So last year's valuation, we brought our projected employer contribution rate of 40.8%. That's at the very bottom of this 2018 column, the middle column. Restating that number, we come up with an expected contribution rate of 40%. And so the new projected contribution rate, taking everything into account for fiscal year ending 2021, the contribution rate is 40.6%. So it's a 0.2% reduction from what employers are paying this year, the 40.8%. So let's go now to page 4.
I'm sorry, Sean. So in 2018, the employer contribution rate, was it 38 or was it 40.8?
It was actually 37.9. Because we determined the 2018 contribution rate in the prior fiscal year. So they were actually paying 37.8, and we restated last year that number to be 38%, which was, basically the same. So this year, the 40.8%, that's our restated fiscal year in 2020 rate. No, that the 40.8% is last year what we expected the fiscal year in 2020 rate to be. We're restating that to be 40%.
So it's going up and not as much as we thought it was.
So the projected rate for the next year, 40.6, is going up. It's going down compared to what we projected from 40.8 to 40.6. It's an increase compared to our restated, but compared to the one that really matters, which is what employers pay, it's a small decrease. But it's important to look at two numbers there. One is the rate. The rate is decreasing from 40.8 to 40.6, but the dollar amount, what we expected employers to be paying this year is $765 million. But because payroll is higher than we expected, we now think employers will be paying in something higher. And our projected fiscal year in 2021 dollar amount is $791 million. That's the number right above the 40.6%. So I know it's hard to keep up with it. I could add some years in here, but I guess y'all tell me if you think that would be helpful. There's already an awful lot of numbers on this page. Okay, so the next page, page 2, is the breakdown of the fiscal year end 2021 contribution rate by plan. So you see the very bottom, the 40.6%, that's the aggregate reduction from the 40.8 to the 40.6. Most plans are seeing a decrease. The only exception to that is, I wrote in the prior year numbers, I'm not going to read them all out, but Harbor Police is having an increase from 7.7 to 12.1. Judges and court officers was 42.4, is now 42.5. And it looks like most of the other plans are, peace officers, a small increase. Most of the other plans are having a decrease. ATC is having an increase. There's a lot of variation in those small plans because we have, in many of them, we have less than 10 members. And so as one member drops off and there happens to be a remaining member with a higher normal cost or lower normal cost, it's gonna result in a lot of variability in those numbers, and it's just because they're so small. Let's go to page 4. And walk through the impact of each of the items that we've discussed. We talked about how they impacted the UAL. Let's talk about how they're impacting the contribution rate change from the 40.6 to the 40.8. So even though it's a small decrease, there's a whole lot of changes going on up and down that net out to that 0.2% reduction. So the first one is the demographic shift. That's essentially just the fact that there's slightly different members now than there was a year ago, combined with we have more members moving off of the older plans and into the new lower cost plans. And so we're pretty much almost always going to see, in the absence of other changes, a small decrease here as more and more members are moving to the lower cost plans. with the 62% retirement eligibility. The discount rate changed from 7.65 to, or from 7.6 to 7.55 because the projected contribution rate is now being determined at 7.55% discount rate. So this year that we're in, the discount rate 7.6. Next fiscal year, it's going to be 7.55. So that increased the discount rate by 0.09%. It increased the contribution rate on the normal cost portion for 0.09%. And then for all of the other assumption changes, we expected about a 0.4% reduction, and that's what we saw, 0.41%. So that nets out to almost a 0.5 reduction in the normal cost. The UAL payment, we had the investment experience loss, so the $285 million that we had to amortize over 30 years, that resulted in a 1.26% increase in the contribution rate. The other experience loss for all other assumptions was an increase of 0.42. The statutory UAL payment change. So there's a lot of things going on in that number. What it's supposed to represent is back when we had UAL payment increases every year, where remember we had a 4.5% UAL payment increase on the current schedules. And then after Act 497, it was more like 5 or 6%. And now the only increasing schedule is the OAB that increases at 2% per year. All the other schedules are level. But remember, we re-amortize the OAB and the EAAB in this valuation to their original payoff dates. So the OAB, which includes the IUAL, was re-amortized to 2029, and the EAAB is re-amortized to 2040. And so the impact, and we anticipated that last year, but the change in what we expected versus what it actually ended up being is built into here. The contribution variance payment change, we just had a very small payment that's now been paid off. So that's why there's a small reduction there. The other assumption change, this is the other, all the experience study related assumptions resulted in a small decrease in the UAL payment of 0.07%. And then the change in the discount rate from 7.6 to 7.55, because remember this is all about the projected contribution rate, had a 0.27%. And that plus the 0.09, the net impact of every 0.05% reduction in the discount rate increases the contribution rate by about 0.35%. That's what we've been seeing, and that's what we're seeing again this year.
What was the dollar amount?
From the discount, I'd have to get you that. Yeah.
Stop, Shelley, please. No.
Actually, I can tell you in just a minute. It's in the back of the report.
So Shelley, does the surplus payment, is it significant enough to change any of these numbers at the end of the year?
No, not really. That also figures into the statutory UAL payment change because that was a part of the reamortization. If it did, it was probably to the 0.01, so it might have had a rounding impact, but probably not. So the payroll, I'm sorry? Okay.
You erase that comment.
The pay.
Look, I tell you that you're having a rounding effect, that means you go ahead.
It means I'm looking for crumbs to give you. So the payroll change, remember I mentioned that the almost 5% increase in aggregate payroll ends up helping the contribution rate because we're paying the UAL payment as a percentage of payroll. So when we're paying it as a percentage of a good bit higher payroll, it decreases that. And so that had the impact of reducing the contribution rate by 1.42%, which is really significant. We were lucky to have that to offset the number right above it, which is the increase in the UAL payment. And so sum all of those up and you get to 0.19%, which is, we never expect those to add up exactly because it's not additive. They all kind of work together. And so that explains the reduction of the 0.2%. Let's go to, what do we want to see next? Page 12. So these are numbers that I used to tell y'all, and you kind of pencil them in. And last year, or maybe the year before that, I added it to the valuation so you can actually see what the expected impact of future smoothing is going to be. Because we know we recognize 20% of the actuarial investment experience gains and losses each year. So we always know what 4 of those years are going to be coming in. We just don't know what the most recent year is. So I map out for you what of the 4 years that we're going to be rolling in the 2020 valuation, it's a net loss of $160 million. So if we have an investment experience gain next year, a market value gain of $160 million, that's going to be taken away by the other losses that we're smoothing in. And so for 2021, we know 3 of those years, and we're starting out with a gain there of $72 million. So this isn't really, it's just more FYI, because it's always good to know, how do we expect future valuations to be impacted by things that we already know. Let's now go to Appendix D, which starts on page 56. If y'all remember back in August, I did a presentation on a new actuarial standard that says that it's an actuarial standard of practice that actuaries have to address the risk of any work that we do, whether it be a valuation or if we're pricing a benefit change. We have to not only include the impact that we're pricing, but we have to include some discussion on how what we're providing is an estimate, and that there's risk that estimate may or may not be realized. And the standard gets real involved in some of the things that we have to talk about. And so this section is a discussion of all of those items. I'm not going to go through every one of them because we talked about a lot of this when I did the presentation back in August, and it's pretty straightforward for you to read. But one thing that I think that that is, for me, and I'm sure for you guys, it's a very welcome addition, and that is page 57, the other considerations. So I talked about all of the risks that the actuarial standard says that we're supposed to discuss, but one thing that's not in the standard that I felt like was very applicable to lasers is the change in the risk going forward because of the legislative changes that we've had over the last 10 years. So I put just some bullet points in here that say, yeah, we've got a bunch of other risks from other things like investments. We might earn less than we expected, we might earn more than we expected. And none of that is really quantitative unless y'all want me to do a thorough quantitative analysis. Maris, thank you for the eye roll. But this does walk through each of the items that I think significantly reduces lasers' risk of losses going forward. And I could read through them, but they're all things that we've discussed before and y'all are pretty much familiar, so just let me know if y'all have any questions. The next few pages, you'll see some tables, and there's nothing new here that I didn't already present to the board in August to let y'all know that this is coming, except that I do have some more discussion in here. So if you just read over it and let me know if you have any questions, I think I'd rather do that than walk through all of it, because it's all pretty self-explanatory. Just a few more things. Turn to page 78. I think this is always good, just a good reminder to let y'all know is in here. This is the projected UAL balance and payments based on our projected UAL as of next year's valuation, 2020, because we have to do that projection to determine next year's contribution rate. And so that's the basis of how I build this chart. And you see that we continue to expect a very sharp decline in the UAL. That's because we're making principal payments on it now, pretty significant principal payments. And then you see that the payments remain fairly level until 2029 when the OAB will be paid off, because remember, we've re-amortized that. Last year, it would have been, the payment would have reduced prior to 2029, but we've re-amortized that to 2029. And then the EAB is paid off in 2040. That's why that stays fairly level until then. And then the payments drop off to zero.
So Shelley, is there anything that would keep that payment from dropping as it is? I mean, I assume the surplus could make it drop a little more, but what could happen to make it not drop?
Okay, so well, let me just answer the easy one, the surplus that you just addressed. So that the surplus will only impact the payments. Are you asking about the UAL or the payments? The UAL. Oh, okay. That will immediately reduce the UAL. It won't immediately reduce the payments, even though we are talking about a number that might not be material, but it wouldn't impact it anyway until every 5 years when we do the reamortization. So now when we receive those surplus dollars or when we have investment gains up to our hurdle amount, those will not impact the employer contribution rate until another 5 years from now when we reamortize. What can increase it? Experience losses. So going forward, we can have investment experience gains or losses. Gains will reduce this. Losses will increase it. Anytime we reduce the discount rate, we're going to increase the UAL. So change in assumptions, which that for the next 5 years, the only change in assumptions should be the discount rate, unless we feel like another change is warranted, but that's generally not the case. We generally only change those every 5 years. And other experience losses. So if something were to happen and we had a large number of employees retire before we expected, that could cause a material experience loss. Or mortality, if people live a whole lot longer than we expected, that would cause a experience loss.
Speaking of living
So.
long, I'd like to propose that if any of us are alive in 2050, that we come back together and celebrate the UAL being at zero.
Put that in a time capsule somewhere.
I'll be,
You'll be 90 then.
Well, just a more,
You'll be here then.
I mean, some of you will be around in 2029, hopefully, and I think just getting that UAL paid off.
Somebody.
Not around, but here at this board meeting.
Gee, Shelley, keep going.
Trying to be positive, it's difficult. So I think that is,
Well, I think you need
The
to
highlights.
go on page 58 to the funded ratio, and where, but for the changes we made, that our funded ratio would be almost 70%.
oh, yes, that's a very good point. I'm glad you saw that. So I did add in here some information, middle of page 58, about the middle of that paragraph. Well, let's just read it. The funded ratio determined as the ratio of the actual value of assets to the total accrued liability has increased over 10 years from 57.7 to 64.1, which over 10 years, that's a nice increase. This ratio generally reflects the financial health of the plan, but should not be considered in isolation since there's been so many changes in the assumptions and the methods. For example, during this time, Lasers has reduced the discount rate from 8.25 to 7.6, changed the actuarial cost method from projected unit credit to entry age normal, and the combination of those two things alone increased the UAL by 1.6 billion. And if we hadn't done those things that make the plan more, the change in the funding method to entry age normal make contribution changes more level, more predictable, less volatile. But changing the discount rate is going to increase our probability of gains, decrease our probability of losses, so it's contributed to the health of the plan. It just unfortunately increases the UAL. So this shows if we hadn't done those things, the funded ratio would have actually increased from 57.7 to 70%, and that's huge.
Huge.
That's huge, and that's a reflection of all of those bullet point items that I listed that are reducing the risk of the plan and improving the financial stability of it. So I'm glad you noticed that. I meant to point that out.
Look at you. Little brown nose.
Just want it on the record.
Yeah, that's important.
Credit card, too.
Oh, my God.
Any questions? Cindy, you wanted to know the impacts?
Yes, I do.
Okay. Well, I can tell you part of the impact.
No, I want the answer. Don't try to cheat. Tell me later if you don't know.
Okay. Well, the UAL increase is 88.1. The impact of the payment is about 7.2 million per year to the UAL payment. There's a slight increase in the normal cost as well. And that's the one I don't have. But I can tell you later.
No, it's incomplete.
Okay, any questions?
You did a good job, Shelley.
Thank you.
I look forward to it.